you've generated significant amount of growth, and access to capital is clearly key to support that growth. How does, maybe start at the higher level, how does access to capital impact your strategy? We talked about some of the periods of market dislocation.
Well, it's the lifeblood of our organization. We are heavy consumers of capital. If you think of the businesses that we own, they are capital intensive. And so we need to have access to capital to refinance operations and to fund growth. We've always, I think from the very early days, taken an approach that we want to be partners with capital providers, not treat it as a transactional relationship. And that means there's give and take, points through a cycle, and your behavior matters and people remember your behavior. We firmly believe in non-recourse asset level financing. Every business, every asset, everywhere we buy across the organization has to raise debt that is sized to its cash flow profile, that is sustainable through a cycle for that individual asset. That maybe creates a lot more work for people because it's much easier just to issue a bond up of your corporate, and it creates more complexity and more cost, but it absolutely pays fruit because you build these relationships with lenders that know and understand your asset class. So in good times and bad, you're dealing with people that are committed to the sector. And if you ever have circumstances that you run into where an asset severely underperforms, which does happen occasionally, you're dealing with that on an individual isolated basis. And so our approach has been a partnership-driven model. We value partnerships and relationships. Like our strongest relationships would be those banks with balance sheets that are partners and can bring extra expertise as opposed to leading with that kind of expertise first. So it's kind of a partnership model. And it's proved itself time and time again.